Gold is supposed to be the ultimate safe haven asset. War starts, panic rises, and gold should go up. That's the rule most people think they understand. But this time, something shocked the market. Even with war risk, even with missile headlines, even with global fear rising, gold didn't just stall. It dropped hard. So what happened? Why would gold fall in the middle of a war story that should have pushed it even higher? And here's the bigger twist. In 2026, this is not just a human reaction market anymore. This is a market driven by macro fear, global liquidity, machine speed positioning, and AI-assisted interpretation of headlines. Today, I'm breaking down exactly why gold dropped during this war, what changed in the last 24 hours, and why AI-driven market behavior may be making these moves even faster and more violent than most investors realize. Let's start with the paradox. At the beginning of the conflict, gold did exactly what people expected. War risk exploded, uncertainty surged, and investors rushed into classic safe haven assets. Reported that gold briefly climbed above $5,400 earlier in the conflict, and noted that gold had already hit a record high of $5,594.82 per ounce on January 29th. So yes, the first reaction was absolutely bullish for gold. But then, the market changed character. By March 24th, said spot gold had fallen to around $4,289.26, down more than 21% from the January peak and nearly 17% since the war on Iran began on February 28th. Also described gold as firmly in bear market territory after a brutal sell-off. That is the part that confused millions of people. If war makes markets nervous, why didn't gold keep climbing? The answer is that gold was no longer trading on fear alone. It started trading on inflation, interest rates, the US dollar, bond yields, liquidation pressure, and speculative positioning. And that changed everything. To understand the drop, you first need to understand why gold rose. When the war escalated, investors saw higher geopolitical risk, possible energy disruption, and major uncertainty around the Middle East. Reported that the US-Israeli campaign against Iran intensified, while concerns over the Strait of Hormuz and energy supply kept oil prices elevated. In moments like that, gold usually benefits because it's seen as a store of value when confidence in the broader system weakens. So the first move made total sense. Money moved toward protection. People didn't want pure growth risk. They wanted something old, hard, and globally recognized. That's gold's brand. But here's where many retail viewers get trapped. They think gold only reacts to fear. It doesn't. Gold reacts to the kind of fear the market thinks is winning. If the fear is system collapse, gold can rise. If the fear becomes inflation stays hot and rates stay high, gold can get hit, even during war. That's the key transition. The war didn't just create fear. It also created an oil shock. And that matters because the market quickly began to focus on a second-order effect. Higher energy prices can reignite inflation. Reported that the conflict and disruption risk around the Strait of Hormuz pushed up energy worries and supported oil prices. Analysts said the market started looking at higher oil prices and the possibility of hotter inflation. Once that happens, traders stop asking, "Is this scary?" and start asking, "Will central banks keep rates higher for longer?" That is the moment the war trade became an inflation trade. And an inflation trade is not automatically bullish for gold. Yes, gold is often called an inflation hedge. But in real markets, gold tends to do best when inflation is high and investors believe rates will eventually fall or real yields will become less attractive. If inflation jumps and central banks sound more hawkish, gold can struggle because it offers no yield. So, the market moved from buy gold because war means fear to sell gold because war may keep rates elevated. That's the switch most casual viewers miss. Gold does not pay interest. It does not pay a coupon. It does not pay a dividend. That means when US Treasury yields rise, gold becomes harder to justify for many large investors. And multiple analysts all pointed to the same pressure point: higher Treasury yields and reduced hopes for aggressive Federal Reserve rate cuts. Said the Fed projected higher inflation, and Chair Jerome Powell emphasized unusually high uncertainty because of the war. Added that persistent inflation reduced the likelihood of aggressive Fed cuts and kept Treasury yields elevated. This is where the safe haven narrative breaks down. Because if an investor can get a higher return parking money in treasuries or dollar assets while gold just sits there, some of that money rotates out of gold. That's why you saw a bizarre market structure. War was bullish for fear, but fear was bullish for oil. Oil was bullish for inflation risk. Inflation risk was bearish for Fed cuts. Fewer Fed cuts meant higher yields, and higher yields were bearish for gold. That's the chain reaction. The second major reason gold fell is the US dollar. In crisis periods, investors don't always pick only one safe haven. Sometimes they choose the dollar over gold. Repeatedly noted that a stronger US dollar made dollar-priced bullion less attractive to overseas buyers. Also reported that the dollar index had strengthened around 3% since the start of the war, reducing the appeal of greenback-priced bullion. In other words, the same fear that should have helped gold also boosted demand for dollars. This is incredibly important. Retail audiences are often taught a simplified story: bad news equals gold up. But in real global markets, bad news can also mean US dollar up, Treasury demand up, real yields up, risk assets down. Margin pressure rises and gold gets sold to raise cash. So gold was fighting not just one competitor, but two: the dollar and high-yielding fixed income. And during this phase of the conflict, gold lost that battle. Now we get to the part that usually makes the biggest moves: positioning. Gold had an enormous run before this drop, said gold rose 64% last year, and described the sell-off as a natural correction after an extended rally fueled by geopolitical uncertainty and structural demand. When an asset has gone up that much, it does not need a full narrative collapse to fall sharply. It only needs an excuse for large funds to reduce exposure. Told that this pattern often happens during stress, investors raise cash to meet margin calls or lock in profits where they can. Also quoted analysts saying recent volatility reflected a significant rise in speculative investment flows and then a sharp exit of that capital. So part of the drop was not about people suddenly hating gold. It was about people needing liquidity, managing leverage, and unwinding crowded trades. That's why war headlines and gold prices can temporarily disconnect, because in a leveraged market, what investors need to sell can matter more than what they want to own. Now let's bring in the AI angle. And this is where your video becomes different from everyone else's. I want to be precise here. AI did not start the war. AI did not create inflation. AI did not decide central bank policy. But AI may be helping markets process, amplify, and crowd into reactions faster. Says AI and machine learning have played a major role in its investment process for years, and that large language models can analyze analyst reports, earnings calls, news articles, and social media to help inform investment forecasts. That means the modern market is increasingly interpreting information at machine speed, not just human speed. Explains that sentiment analysis applies algorithms to news, social media, and other data sources to gauge how people feel about the market. Another piece warns that AI-driven investing can create attention bias, where popular, heavily discussed ideas attract even more AI-assisted focus, increasing the risk of crowding and herding. So what does that mean for gold? It means the market may be reacting to war headlines, oil headlines, Fed headlines, and dollar headlines in a more synchronized way than before. If the dominant narrative flips from geopolitical fear, sheer buy gold, to war, sheer inflation, sheer higher rates, sheer stronger dollar, sheer sell gold, that shift can spread rapidly through systematic strategies, quant models, sentiment tools, and AI-assisted research workflows. In simple terms, AI didn't invent the trade, but AI may be making the trade travel faster. And when everyone is reading the same headlines, ranking the same signals, and rushing toward the same conclusion, the move can become much more violent than the public expects. That's one of the most under-discussed reasons why gold looked so strange during this war. Now let's talk about the latest update today. On March 25th, reported that gold rose more than 1%, with spot gold around $4,546.59 per ounce after hitting a 4-month low on Monday. Said the rebound was helped by falling oil prices, easing inflation worries, and optimism that hostilities involving Iran might be diminishing. Reports of a proposal aimed at ending the war helped cool the inflation narrative, which in turn eased pressure on gold. Also showed gold around $4,567 on March 25th, up on the day but still down significantly over the past month. So today's move does not erase the broader sell-off. What it tells us is that gold is still extremely sensitive to changes in the market's inflation and rate expectations. That means the gold story today is not gold is dead, and it's not war no longer matters. The real story is this: gold is now being pulled between two competing forces. One force says uncertainty, deficits, de-dollarization, and central bank buying are long-term bullish. The other says oil shocks, sticky inflation, a stronger dollar, and higher yields are short-term bearish. And right now, the market is violently swinging between those two stories. Yes, but not in the simplistic way social media explains it. Quick disclaimer: this video is for educational and news commentary purposes only. It is not financial advice, not trading advice, and not a recommendation to buy or sell gold, ETFs, mining stocks, or anything else. Markets are moving fast, and geopolitical events are still developing. Gold is still a safe haven over longer cycles of uncertainty, monetary stress, and loss of confidence. Quoted analysts who still maintain a constructive long-term view because of structural drivers like geopolitical risks, fiscal concerns, and ongoing central bank demand. Also noted that central bank reserve diversification is expected to continue, but in the short term, gold can absolutely fall during war if the market decides the war is more inflationary than destabilizing, more rate hawkish than recessionary, or more dollar bullish than chaos bullish. That is the real lesson. Gold is not a one-button fear trade. Gold is a macro asset, and macro assets respond to the full chain: fear, oil, inflation, Fed, yields, dollar, positioning. If you only look at the first word in that chain, fear, you'll miss the whole move. For a US audience, this story matters because it explains how the market really works in 2026. Americans are watching war headlines, inflation headlines, AI headlines, and Fed headlines all hit at the same time. People want a clean story, but this is not a clean story. This is a story about a market that is no longer reacting in one straight line. It's reacting through global oil routes, central bank expectations, treasury markets, dollar demand, leveraged fund positioning, and increasingly, AI-assisted information processing. That's why viewers feel confused, because the old-school rulebook says gold should rise in war, but the new market structure says not always, not when inflation fear is winning, not when the dollar is getting stronger, not when yields are rising, not when traders are dumping winners to raise cash, and not when machine-speed systems are accelerating the same narrative all at once. So here's the bottom line. Gold fell during this war, not because gold stopped being gold. It fell because the market stopped seeing the war as only a safe haven event. Instead, it began seeing the war as an inflation event, a rates event, a dollar event, and a liquidity event. That pushed Treasury yields higher. That strengthened the dollar. That increased the opportunity cost of holding gold. That triggered profit-taking and liquidation after a huge rally. And in a market increasingly shaped by AI-assisted analysis, algorithmic sentiment, and crowded information flows, the shift happened faster and harder than many people expected. Today, gold is bouncing because oil cooled, inflation fears eased a bit, and hopes for de-escalation gave the metal room to recover. But this is still a fragile market, and the next move will depend on whether the dominant story becomes escalation and inflation or de-escalation and lower rate pressure. If you learned something from this breakdown, subscribe, because I'll keep translating complex market moves into plain English, with real context, real macro logic, and real-time updates. And remember, in 2026, markets don't just move on fear, they move on how fear gets priced. Quick disclaimer, this video is for educational and news commentary purposes only. It is not financial advice, not trading advice, and not a recommendation to buy or sell gold, ETFs, mining stocks, or anything else. Markets are moving fast, and geopolitical events are still developing.